Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky. We have Kevin Cummings on the line. He's the CEO of Investors Bank, the NASDAQ symbol ISBC. Kevin, how you doing this morning?
Good, Joel. Great. It's the end of the second quarter, and the year's going along very well for us.
Well, good. And we want to hear your predictions for the second half of the year. But before we get into that, can you give us just a brief background and how you ended up at the CEO of Investors Bank?
Yeah, today's kind of my anniversary. I started at the bank 12 years ago on July 1, and after a 26-year career with KPMG, I was an audit partner in the New York and New Jersey financial services practice, and Investors was one of my clients back in the 80s, and I knew the account very well. And back in 2002, my predecessor's predecessor had died suddenly of a heart attack, and my predecessor, Bob Cashel, our current chairman, decided to take the bank in a different direction and hired Don McCammer, our CFO, our current COO, and hired me in 2003. And our job was to change the direction of the bank from a sleepy thrift focused on mortgage-backed securities to a full-service community bank.
And so who are your peers in the banking community?
Yeah, we like to say we don't have any peers, but we have many peers. Here in New Jersey, it's Valley National, Provident, and we compete well with the national banks, in the middle market area, B of A, Wells Fargo. But it's really in New York, it's Signature Bank and Astoria, Dime Community, Flushing in the multifamily space. But we're trying to differentiate ourselves a little bit and be more of a middle market relationship bank. With the mergers of Norfolk Bank back years ago to Capital One, and I don't know if you remember UJB / the old Summit Bank here in New Jersey. It was the largest bank that was acquired by Fleet years ago. There's no middle market bank focused on New Jersey, New York-based companies. And we feel that's a great niche for us to develop as we move forward in this transition from a thrift to a community bank to a full-service commercial bank.
And how many branches do you have?
Well, today, back in 2007, we had 45 branches. Today, we have 135.
Wow. All right.
And we've been expanding. We're a little bit of an outlier on that because, we're more of a growth story, Joel. We've grown from just shy of $6 billion at the beginning of the recession at the beginning of 2008 to almost $20 billion today. And we've taken our deposit base from $3.2 billion to over $12 billion today.
So in expanding the company, could you talk about some of the challenges that you've faced? Have you tried to expand by acquiring other banks, or you just go for the organic growth?
Well, to date, like I said, we've grown about $14 billion in the last 7.5 years. About $4.5 billion of that growth has been through acquisitions. We completed 8 acquisitions since 2008, and a lot of them were underperforming, impacted by the recession or impacted by a poor business model, were opportunities for us to buy them inexpensively. For $4.5 million, we have less than $77 million of goodwill on the books as a result of those acquisitions. And we were able to inject our energy and management of those franchises, those underperforming franchises, and create some great opportunities both for the people and for the customers because of our service model.
Coming out of the financial crisis, different regulations from the government. One of them was the Dodd-Frank regulations. I don't know if you guys do a whole lot of trading or market making. Did it affect you guys at all?
Well, certainly Dodd-Frank affects all banks. I mean, even if, especially as we were we were about the only bank when Dodd-Frank came into effect in that quarter. We were the only bank to pass $10 billion. During that period of time. And actually they had to, have almost a special rule for Investors Bank as we moved into the regulation by the Consumer Financial Protection Board. So, having that additional regulator certainly changes, the aspect of the game. Having to do things like the stress test, is additional regulatory burden. But to me, the whole regulatory environment, I never complain about it, Joel. I look at it as an opportunity because we're of a size where we can make these investments, whereas smaller banks, maybe under $2 billion, under $1 billion, it really becomes a burden for them to deal with the BSA, the anti-money laundering, and all the regulatory requirements that we have. And hopefully, the comment, hey, it's not fun anymore. The regulatory burden is making it more difficult for me to generate certain returns. And hopefully they'll look to partner with a larger institution that has greater efficiencies and that can manage that risk more appropriately.
All right, let's go a little bit more broad here. We've seen as of late some strength in the financials, I guess because of anticipation of higher interest rates. Do you expect this trend to continue?
I think yesterday was a tough day. A lot of it is macro-driven. So when you look at what's happening in Europe with Greece and then some of the other things, the slowing down of China, it's really so many things are interconnected now that it's, I guess the answer is, I think across the board, I think it's going to be like the economy. It's going to be baby steps along the way, slow and steady. Now, as rates begin to rise, it's not the rise, people are so concerned, when the Fed, September, December, when are they going to do it? It's more the steepening of the yield curve. Because if the yield curve flattens, that's not going to help financial institutions, banks and thrifts. If it steepens, if it flattens, it's not going to help. If it steepens, then you're going to see more lending and more opportunities for expansion of net interest income.
Okay, so what's your take on the Fed here? You think they're going to make a move in September, December? Is the data coming out from the economy really support a hike at this time?
Well, just recently, home sales, had the best month ever in, I think, the month of May. So I think as the construction business and the real estate, the residential real estate improves, the problem is that the first-time home buyer, it might be because of student loan debt or other reasons, changing demographics. People want to stay in apartments longer. The millennials don't, have seen what happened to their parents in 2008 in real estate prices. The first-time home buyer isn't at the table yet. So I think it's going to be a slow, steady slog. And I think as rates, the Fed, I think, has to raise rates in 2015. Now, we've said that the last 2 years here at the bank, but I really believe that you're going to see at least 25%, 25 basis point, and it's going to be a non-event, I think, because they've kind of prepared the market so much for it. September, we're going to see it, and then we'll see how it reacts, and we'll see what happens, with the Fed buying, securities, mortgage-backed securities on the open markets, and we'll see what happens going forward.
And on the show, we often debate about, higher interest rates and really how they, affect the banks. I think the simple, straightforward is, interest rates are higher interest rates are better for banks. What's your take?
Higher interest rates are better for banks. But a flat yield curve is bad for banks.
Okay.
So a steepening yield curve, the higher end, the spread between the 2-year and the 10-year, if that's larger, that's helpful to banks.
Okay. All right. And you kind of touched on, the economy as a whole. Just, final thoughts on the markets and the economy.
Well, Joel, when you look at where we are, and back in 2009, I made a statement that we're in the lost decade, similar to what Japan went through in the 90s. And really, I think if things started going sideways with Bear Stearns in 2007, and I think we're in a 10-year, similar type 10-year period where it's slow growth, but, there is growth. It's very bumpy. Companies are very defensive. They're hoarding cash on their balance sheets. They're buying back stock, not making investments. And I think until we have a fundamental change in our tax structure in this country, I don't think, we're going to see that massive explosion that we were happy to see during the Clinton years in the 90s and the Reagan years in the 80s. So unless there's some structural, Bowles Simpson, some structural changes, I think we're going to be on this 10-year, maybe it might be even be a little bit longer, this just what I think some people have coined the new normal, where it's just low growth, but just steady and hopefully lower volatility.
Okay. Do you mind commenting on some of the other banks here that we like to follow, like a Goldman Sachs? Any outlook on that issue? It's had a nice run up, a little bit of a pullback. Can you give us any comments on, the really only two investment banks that are still around, Goldman Sachs and Morgan Stanley?
Yeah, I'll tell you, it's interesting, their model and how they've adjusted and risk adjusted their models, over a period of time. And I think it's a global, businesses. It's a highly fee generated, not just tied into interest rates. We speak with some of the investment bankers from Goldman from time to time. They're very, very competent people. So I think, those companies, diversity of the earnings, both from a geography point of view and from a product point of view, I think they're great business models and great opportunities to diversify your investments over the longer term.
Okay, and someone just real quick, just talk about some of the big banks here, Bank of America or Wells Fargo. Wells Fargo didn't get quite saddled in the financial crisis like Bank of America did. Warren Buffett's biggest holding. Any take on Wells Fargo?
Well, I think Wells Fargo is a great competitor. Their acquisition, of Wachovia was a master stroke. Was a very opportunistic acquisition. It brought them into the East Coast, and they are executing well. They're a good competitor here in New Jersey and the New York market. But I think they're a global player, and we always say, what would you rather deal with, a management team here in New Jersey or someone in San Francisco? So we look at the larger banks are almost like to a mid-sized bank like us. The larger national banks, we sometimes say, are the gift that keeps giving, because they're in and out of the markets. They're not as close to the market as we are, and sometimes we can service that middle market client a little bit better. And when they're looking for the $30, $40, $50 million loans, we can do the $5, $10 million loans, hopefully a little more efficiently.
We've been on the line with Kevin Cummings. He's the CEO of Investors Bank, joining us here on Benzinga's Pre-Market Prep, giving us a good look at the banking sector. Good luck with your continued expansion, and we hope to have you on again soon.
Thanks, Joel. It's good spending some time with you, and have a great 4th of July weekend.
All right. Thank you.